Good morning, everyone. Ron Bullis here, the co-founder and CEO of Lifeworks Advisors. And I just want to say welcome to all of the new clients who are joining us and all of our existing clients. I hope that you find this June market update informative and fun. I hope that you're also off to a great start to summer. It is a beautiful day here in Michigan. And right after this market update, I head out on my annual spring fishing trip with Kurt Van Dyke and our co-founder. So the only thing standing between me and an ice cold one and some lake fishing is this market update. So I am going to be moving at a pretty brisk pace, but really excited to get to be here this morning and share with you guys some of our team's thinking, what we're watching in the market, and some of the questions that we have and what we're going to be watching over the coming weeks, especially with a lot of the news and events, key events that are coming up here. So I'm going to jump right in. The theme of today's market update is more of the same. Here's an interesting quote. Inflation is the tiger whose tail central banks hold, usually with trepidation and ideally from a safe distance. If central bankers wait to see the whites of this tiger's eyes before acting, they risk having to run like the wind to avoid being eaten. I'd like to say that central banks have a good track record with this, but if you're a student of history, you look back at how the central banks, both in the US and Europe's performance has been around trying to maintain inflation or tame this tiger or hang on to it from a safe distance. It hasn't been a great track record. So obviously, one of the things that we are watching and keeping a close eye on, as is hopefully our most everybody else who are managing assets in the market, is what is going to be the impact from all of the Federal Reserve's monetary policies, the immense amount of cash that they've pumped into the system, the immense amount of federal government spending kind of combined with that, like a right hand, left hand combo punch. And we're going to dig into this a little bit deeper. So let's take a run at what this is going to look like. Here's the agenda for today. Again, I'm going to go through this pretty fast paced. If you've been on one of our live webinars before, know that right below the video, you can scroll down just a little bit. You can ask questions live while I'm giving my presentation. I have them right up here on the screen to my left. I will try and pause and answer them midstream. If I don't answer your question right away, we will circle back to it at the end during our Q&A. If you have to jump off for whatever reason, back to work, something interrupts you, we will be sending out a link to the presentation in its entirety along with the slides, probably by the end of the day, if not by tomorrow morning at the latest. So if you miss something, you want to dig into something deeper, or I run through it too quickly, don't hesitate to pull up the slides, shoot us an email or a phone call, and we're happy to talk you through it in more detail. So here's going to be our agenda. We're going to talk about the economic situation that we're in today, specifically inflation, question mark, yes, inflation, and inflation. We're going to talk about unemployment and the employment situation. We're also going to look at market returns by segment. Where's the overall equity market sitting at year to date, and what are some of the different sectors of the equity markets? And then we're going to look down the road a little bit, something we're going to call a global divergence. We're going to talk a little bit about a K-shaped recovery. What is a K-shaped recovery? Why are we talking about it? What are the implications for you and for other investors? And then we're also going to look at some interest rate scenarios. Just saw a typo in my presentation there. I'll have to correct that before I send it out. All right, so if you have been watching any news or you have been online at all, you have probably seen headlines screaming about inflation at the highest rate maybe since the 1980s, record inflation, burning hot inflation. And that's true. However, and this is where we'll get into the conversation about, is inflation that we're seeing right now, is it going to be transitory? Meaning, is it just a recovery from the significant fall in productivity and output and prices we saw in early 2020 due to COVID? Or is this something that's more of a long-term trend that's going to be here to stay? So the dark blue line is CPI for all urban consumers. This is kind of the baseline benchmark that the government uses for measuring inflation. There are other metrics out there that show an even higher number. I tend to subscribe to a few of those other metrics that look at inflation a little bit differently than the Bureau of Labor Statistics and the Federal Reserve does. But for now, this is CPI. This is probably the most widely quoted measure of of price inflation for a basket of goods and services. So the dark blue one is all items, and then the lighter blue one is less food and energy, right? So when we're looking at inflation on a year-over-year basis. And we're seeing it starting to push up into the 4%, 5%, 6% territory. That's definitely something to cause a concern. And the question would be why? Well, one answer would be for every dollar that we have sitting in cash, or for every dollar that we have in investments that's not earning at least the rate of inflation, we're technically losing money in real terms because we're losing purchasing power. Okay? So again, our inflation with a question mark here is this upward trend going to continue, or is it going to slow down and perhaps flatline and return to a level that would be acceptable to policymakers, the central banks, the government, et cetera, and a level that is a little bit easier to navigate for investors and wealth managers like us? Okay, we'll show here in a minute towards the back of my presentation how this interacts with long-term interest rates. So here's another metric for kind of measuring inflation. If you know anybody that's sold a home lately or that's looking to buy a home, you might even been contacted by a realtor. We have clients, I myself actually, was contacted by one asking if we had any interest in selling our home because there's so few homes on the market. So pretty much every major metropolitan area across the United States, the housing market is a little bit bananas. I'm quoting one of my clients I was on a call with last night, and that's exactly the right way I would put it. We are still at some of the highest levels of mortgage delinquency and default we've ever seen in the U.S. We're at some of the lowest levels of foreclosures thanks to the CARES Act, which put a moratorium on foreclosures and evictions. And at the same time, house prices don't seem to have an upper bound to them. They just keep accelerating, driven by low interest rates, easy monetary policy, maybe a combination of all of it. So this is a Case-Shiller U.S. National Home Price Index, and we can see here towards the backside, when you look at 2020 and beyond, you've got this really steep, sharp increase in prices nationally. That's factored in, and that's driving some of the inflationary numbers that we're seeing. Now, there are some things that seem to be getting better. For those of you that don't drive an electric vehicle, I drive a Ford F-150 and like to support the energy industry by driving it like a truck. Gas prices are up significantly from a year ago. Okay. Now, in the last month and a half, they've started to pull back a little bit. Okay. Again, there might be a lot of factors coming in here, but our team's been looking at specific examples and trying to identify certain segments of the economy or certain goods and services and input items and watching those things closely. So gas and energy prices would be one. When we talk about like lumber, connecting it back to the housing market, building supply, this is the producer price index by commodity. This is specifically for lumber and softwood. So softwood would be the pine that they make 2x4s out of, OSB sheeting material, things like this, a key input into home building. I recently started putting an addition on my garage, and from when I had the prices quoted in March until when I actually bought the lumber in May, the prices were up 40%. Wish I would have bought it in March when I had it quoted. Anyway, when we look at this right now through the producer price index, we see this massive uptick in spike in the average price of lumber. If we go forward one slide here and we look at the futures, the way lumber is being priced right now in the futures market, we see something similar to what we saw in the gasoline and the energy market, right? Now, there's a little bit of a disconnect in the line here because there's some days where the futures data wasn't available. But again, what we're trying to do on our team is to look at what's happening in the market right now and looking through the headline around inflation and saying, what are some of the actual major inputs that are going to be driving the economy, right? So lumber and building supplies would be one, gas energy would be another. And there is some good news here. There is some data that suggests that this idea of the inflation that we've been seeing this year, that it could be transitory, meaning it might level off and then return to more of a normal kind of historical level of inflation that the Federal Reserve and the policymakers are targeting, which is roughly around a 2% inflation rate. Additional case here about the markets thinking that inflation is transitory. So this is the 1 month change in CPI. And so if we look at the right side of the chart here and we see, January, February, March, April, May, what we're seeing is we hit this peak in month over month change in inflation so far anyway this year. We hit that peak in April, right? For a lot of states in the US, they started reopening in Q1 of this year. Now, some states like Florida and Georgia and Texas, et cetera, theoretically have been open through the whole pandemic, but a majority of the states across the country started kind of relaxing COVID restrictions and reopening as the number of people being vaccinated and as the case counts were dropping. So there's also some logic to seeing how the cost of goods and services was ramping back up as economies were opening up, people were spending money, people were going out to eat, people were engaging, people were traveling. And we saw this spike in April, we saw kind of this high water mark, and then May's was a little bit lower. Now this is still, if you add all these up year to date, this is where we're still getting a very high inflation number year to date. But if we're seeing the month-on-month change peak and start to come back down to, again, a level that might be acceptable or more normal, that would support the case for the inflation that we've been seeing so far year to date being transitory or temporary. Another way to look at this is, how are the interest rate markets thinking about inflation? So a core component or a building block of long-term interest rates would be inflation expectations. Because who would want to loan money or buy a 10-year or a 20-year bond, say at a 2.5% yield, if inflation is going to be 5 or 6%? You're essentially buying a loser from day one, okay? So this is the 5-year forward implied inflation rate looking at treasury yields. And what we're seeing here is we're seeing that the forward-looking yield on 5-year treasuries is showing that an implied inflation somewhere just slightly above 2%. Now, none of us have a crystal ball. We can't see into the future, not our team, not any other smart people on Wall Street. So there are still some expectations and there's still a little bit of guesswork that's going on here. But if we look at where interest rates are sitting right now today, right? Interest rates are still very, very low. We haven't seen yields spike, right, because of this inflation. In fact, we've seen yields stay fairly flat, if not even come down just a little bit. So that would tell us that, again, the fixed income markets, the bond markets, the interest rate markets are pricing in this inflation as being something temporary or transitory. Nobody knows. We don't know. The market doesn't know. However, one of the takeaways that we have from this, and I'm jumping a little bit ahead to my presentation, is that we should probably be trying to minimize our exposure to fixed income and bonds where appropriate and where possible, right? Because whether inflation does rear its ugly head and we have something like the 70s and 80s come about again where we have double-digit inflation and we see a massive spike in interest rates, that would be absolutely devastating to a fixed income portfolio in terms of the values today, right? If that happens, we don't want to be sitting in a lot of fixed income right now. Now, conversely, if the inflation is transitory, right, and kind of comes back to a normal level, well, we're also still looking at this and saying we're still likely going to have an inflation rate that's somewhere above what we're earning in yield on the fixed income, meaning we're still in a negative real yield territory, which means we're owning a loser. So there are other reasons to have cash and treasuries and bonds sitting in a portfolio, namely for creating income in retirement. So for those of you that are close to retirement or have recently retired, you know that our Lifeworks retirement system has 3 tranches, right? Tranche 1 is the cash that we need for the next 3 years of income. Tranche 2 is years 4 through 10. And then tranche 3 is everything that's 10 plus years into the future. So our view still is, for the short term, for tranche 1, the cash that we need to create income in retirement today, we are likely still going to be sitting in some type of inflation-protected treasury bond or cash, because that's still the best way to create the certainty around the distribution and not set our clients up for having to take distributions from their equity portfolio when the market's down significantly or when there's a major volatility event. So there are still reasons to own fixed income. We're just going to look for ways to minimize our exposure to it where possible in the other areas of our investment strategies and our portfolios. All right, switching gears just a little bit, let's talk about the job market. If you've been on one of our webinars before, you've been a client for a while, you know this is something I talk about all the time. There is a lot of dislocations in the job market. An anecdotal example is when I drive my oldest son to his soccer practice. We drive through this area of Grand Rapids. It's a manufacturing and kind of an industrial logistics neighborhood to get to his practice field. a few months back, as I was driving through there, I'm seeing signs for signing bonus for, factory, signing bonus for order pickers, signing bonuses for high-low drivers. And they were $1,000 signing bonuses, $2,000 signing bonuses. Last week, as I was driving through there, they're now saying signing bonuses, $4,000, $5,000, right? Whether it's the pandemic unemployment insurance assistance, the PUAs, right? The federal government paying a supplementary unemployment insurance in addition to the state unemployment insurance, whether that's keeping more people out of the job market and kind of sitting on the sidelines or not, there's room for debate on that. But in the state of Michigan, it wasn't until last week that they actually reinstituted the requirement that people who are on unemployment insurance actually look for work. And in the state of Michigan, you only have to log in once per week and show that you did one job search activity to still qualify for unemployment insurance. So while the job market numbers, and we're looking at like weekly number of filings here, one of the things that we're paying attention to is the number of people who are still on unemployment benefits, and that number is still very, very elevated and very high. So in Michigan, you'd collect something like $360 a week for unemployment insurance. The federal government's paying an additional $600 because of the pandemic. So you're making almost $1,000 a week to sit at home on unemployment insurance in the state of Michigan right now. So for entry-level jobs, for unskilled labor jobs, for retail stuff, McDonald's, things like this, it's very hard for an employer to convince somebody to come back to work and make $30,000 a year when right now they can sit at home and make $50,000, $60,000 a year. Again, there's arguments out there that would also kind of push back against that thinking that that's not really what's causing some of the dislocations in the job market, but my belief, and our team shares this, that it certainly is contributing to some of the chaos that exists in the employment situation now. So when we're looking at this graph here, this represents in early March of 2020, this massive, never before seen spike in the history of tracking unemployment insurance in unemployment claims. And then as the pandemic started to kind of move on, the number of weekly claims started coming down. We're still about 3 times the number of weekly new unemployment benefit claims than what we were pre-COVID. So the number is still really elevated. Another way of looking at here is how does the government measure unemployment? Again, if you've been on one of the webinars before, you've heard me talk about this. About halfway in the middle of this graph here, and there's a lot of numbers and text, I apologize, it's kind of heavy, but you see the third row down, it says U3. U3 is the standard definition of unemployment that the media and the government and the Federal Reserve is going to be looking at when they're talking about policies or news headlines, things like this. I like to look at U6. The U6 unemployment number is everybody who's unemployed, everybody who's marginally attached to the workforce, people that are employed part-time for economic reasons, and all people who are employed but not making ends meet. It's a broader spectrum, and I think it's a more realistic measure of people that are unemployed. That number is 10.2% still as of May 2021, and that's a seasonally adjusted number. The unemployment rate that you'll often see on headlines in the news, the government talking about is 5.8%. That's the U3 unemployment rate. Why is this important? Well, the job market has roughly 150 million to 160 million participants, right, over the last few years. So that means we're somewhere in the neighborhood of still of maybe 15 million to 16 million Americans who are unemployed or who aren't making enough money to make ends meet, and so they're actively looking for new work. That's a really, really large number. And that number has moved a little bit since the pandemic, since we've started seeing some recovery from the pandemic, but it hasn't moved a lot, right? And this is something that I think we have to keep our eye on, because I'll jump forward a little bit. When I talk about a K-shaped recovery, what is that? Well, picture a K shape in your head, and then imagine that there's segments of the economy, whether it's by income status, by wealth status, by ethnicity, by geographic location, by industry segment. There are some segments of the economy that are running red hot. They're absolutely recovered pre-COVID levels, and they are crushing it. And there's other areas of both the economy and demographically in the US that are still hurting. They haven't even come close to recovering, right? So it's this idea of a divergence where one group's just taking off and doing well, or multiple groups, and then there's other groups that are still suffering, and that there's significant differences between where we were pre-COVID and where we're at today. Why is that important? Well, it drives things like consumer buying decisions, civil unrest, right? We've seen a lot of that. It basically means there's lots of different pressure points in the economy and in our country as a whole, and maybe even globally, that these dislocations or inequalities, let's say, right, of kind of the economic recovery create significant issues. And I think we're seeing those right now. So we're keeping our eye on this because this will directly have impact on the decisions around how we invest our assets, the types of equities we own, the industries that we're looking at, and things like that. Important quote here. We get asked this, something to this effect quite regularly, right? What this quote is getting at is essentially Richard Breslow's basically saying, look, the only thing that the Federal Reserve cares about, right, are equities, specifically the S&P 500, right? And the FOMC committee is meeting right now. And they're expected to make decisions and make announcements about, do they see, are they planning on changing interest rates or making adjustments to the mortgage bond, the bonds they're buying, right? Are they going to taper their easy monetary policy? The answer to this might be yes, until the stock market drops. And they're going to turn it right back on again. We saw this, a little while back. We called it the taper tantrum, where the Federal Reserve announced that they were going to stop buying as many bonds and buying as much assets in the open market. And when they did that, the stock prices fell. And they immediately resumed their bond buying program. So what does it mean when the Federal Reserve buys bonds or buys assets in the open market? It essentially means they're creating cash, right? They go, poof, they create dollars, they inject them into the banking system, and in return, that bank or that financial institution transfers those bond instruments, the mortgage-backed securities, U.S. Treasury debt, to the Federal Reserve's balance sheet. And the Federal Reserve's balance sheet sits at all-time highs, something just shy of like $8 trillion right now is what the Federal Reserve's balance sheet. Pre-COVID, it was something like $3 trillion, right? And right now, the Federal Reserve is buying about $150 billion a month of fixed income securities. So mortgage-backed securities, U.S. Treasuries, other investment-grade bonds. So putting it together, the Federal Reserve right now is on pace to create another $2 trillion of cash in the economy this year. Put that in addition to the proposed Biden administration budget. This is not a political statement. This is just what's out there, of a $6 trillion spending package, right? And just start adding up that together and looking at the sheer volume of cash and stimulus that's still being jammed into the economy, that's being used to support home prices, asset prices, right, or propping them up. It's probably one of the main drivers of why we see valuations on equities, the stock market, and real estate, et cetera, up. So this slides in here because if the Federal Reserve starts tapering and raises interest rates, if we see negative reactions in the stock market, it's likely that they're going to have to reverse course, meaning the Federal Reserve might be stuck in some regards between a rock and a hard place here, knowing that eventually they have to bring interest rates back to some level of normalcy, that they have to stop injecting cash in the economy. But at the same time, if they do, it's likely that the stock market's going to take a walloping. All right, so that's a lead into this. This is the S&P 500 valuation using the CAPE method. So CAPE stands for the cyclically adjusted price to earnings ratio. This is another metric that our team watches and follows closely. The price to earnings ratio is essentially what is the price of the stock, what is the share price we're paying relative to the amount of earnings that one share is generating, right? And so the cyclically adjusted basically takes an average of a corporation or the S&P 500's average earnings over a period of time. So instead of using just last year or the current earnings, it uses a historical average, okay? And then divides it into the price, right? So right now we are sitting at a CAPE ratio of over 35. That's only ever happened in the history of the US stock market one other time, and that was the tech bubble. Now, that doesn't mean that we're implying that we believe the stock market's going to crash tomorrow or that we're going to have some kind of, significant bear market that's coming, but it is a cautionary tale. It's something that we should be paying attention to, right? We're in a little bit of a world as investors and managing assets for you, our clients, where we've got equity exposure that's at all-time high valuations, and at the same time we've got interest rates that are all-time lows and for the most part negative real yields. It's almost like a damned if you do, damned if you don't. Now, I shouldn't say it's damned if we do, damned if we don't, because we still see positive outlook in the equity space, and I'll cover that here in a minute. There are still reasons to be in equities that have positive results for you, our clients, but this is something we should be mindful of. We shouldn't just be blindly buying the market. We shouldn't just be trying to time the market either. I'll show a slide in a minute that's going to get to maybe some of the worst market timing by retail investors and advisors ever that's happened in the last 12 months. So just know this, that right now, probably driven in large part because of the economic recovery from post-COVID, the markets, the economy's opening back up, easy monetary policy, the Federal Reserve buying, and infusing trillions of dollars of cash in the market, asset price valuations across the board, real estate, equities, et cetera, are very much elevated relative to historical norms. Okay, positive stuff here. Maybe first 2/3 of the presentation might have felt a little negative. Let's talk about some positive things. Year-to-date returns on key market segments, and we're breaking this down, still looking at it from the lens of U.S. equities and the S&P 500 here a second, right? So the first piece up there you see is the S&P 500. There's a little dotted blue line that runs right down the middle of that graph on the left-hand side of the screen. What we see is small caps have outperformed the S&P 500 so far year-to-date. We think that's a sign of positive outlook of the economy reopening and the small and mid-cap companies that were probably hit the hardest in terms of valuations. They were also impacted the most in terms of states being closed and COVID restrictions. Now, as those have been lifted and they're starting to get back to, I'm going to say business as usual, even though it's maybe a new usual or a new normal, right? That's reflected in these year-to-date returns here. We see energy being up significantly, right? This is also something that's kind of, I'm not going to say a no-brainer, but makes good sense when you think about the narrative. If during COVID, everybody locked down, some states completely shut down like Michigan, people stopped traveling, consumption of gasoline, for airlines and for personal use and transportation just dropped, right? Well, now as the economy's reopened and we are seeing factories coming back online, global shipping coming back, trade, et cetera, the energy components and the energy sectors in the S&P are obviously benefiting from that inertia and that momentum right now. Resources, that would be another one on the commodities side, and then financials, right? Also performing well. So businesses have started borrowing again. They're trying to get back to a new normal. Everything's being reset in some regards. When you turn off the global economy, it doesn't just turn back on. I think policymakers are finding that out. The port of entries into the U.S. for shipping containers are an example. Those are just completely congested and backed up. But point here being that even though we have all-time high market valuations and low interest rates and kind of this rock in a hard place scenario, there is still some really, really positive opportunity in terms of the returns in the U.S. equity market so far year to date. All right. So I talked about possibly the worst market timing by retail investors and maybe some of their advisors that I've ever seen. This is a good example of why we don't believe in timing the markets, right? What we're looking at here are total assets in the U.S. equity space, and what we can see in the far right-hand column where it says TTM, that stands for trailing 12-month net flows. So over the last 12 months, retail investors and their advisors have pulled out $108 billion out of U.S. equities, while at the same time, jump down a few rows to taxable bonds, they've moved almost $1 trillion, $800 billion into taxable bonds. I mean, just stop and think about that a second. The S&P 500, and we'll use SPY as a proxy, so SPY is probably the most widely traded equity ETF. SPY has outperformed TLT. So TLT would be a treasury, a long-term treasury bond ETF. So the equity space has outperformed the treasury space by something like 60% year to date. Yet retail investors may be trying to time the market, right? Market went down. They moved out of equities and into bonds. Equities ripped back up. Now, more than likely it's market timing fear driving this move. And it's also driving trillions of dollars potentially into assets that have negative real yields. So the takeaway here is market timing is at best gambling, right? And the house generally always wins. When I talk to people, prospects or advisors, and they tell me, oh, based on this and this and this, I sold this and I went to cash or yada yada. When you look at that over a long-term track record, the ability for any one individual to do that successfully over and over and over at repetition is almost zero, right? So one of the takeaways here in terms of how Lifeworks is approaching this for our clients, right? Do we believe that we should have economic data drive our decisions? Absolutely. Do we believe that we can foresee where the market's going? No. Can we spot trends and themes that we think will impact long-term returns and should inform where we're putting assets? Absolutely. But I'm going to go back to what I was talking about, our tranches, right? The reason that we have a system and framework that's attached to your cash flow and your financial planning needs as opposed to just our thinking about what we believe might do better than, one asset that might do better than another. We believe that the right framework is matching the type of asset to when we need the money for you, the client, right? So we still have a long-term optimistic outlook for US equities, right? Especially when we think about the fact that for us, we're holding US equities in what we call our tranche 3. That's our 10 plus year dollars into the future, right? There are going to be short-term headwinds. Might even be some intermediate dislocations and headwinds that we're facing coming out of COVID and just the unprecedented federal government and central bank intervention into the markets. There's definitely going to be issues that we're going to be facing in front of us here. But in the long-term timeline, we should still have a system and a process that informs how we are allocating assets to the different types of investments and matching those to when we have to spend the money. We believe that is still the best framework for avoiding bad decisions like this, avoiding migrating out of, say, equities and into fixed income just because we believe that it's the right thing to do or because we're afraid of the markets or we're afraid of the all-time high valuations. So a takeaway here would be just because the market's at an all-time high valuation doesn't mean we believe we should take that and then kind of run for the hills, so to speak, and fly into, move those assets into bonds. That could very well end up being a market timing mistake that we don't see making or we don't intend to make, right? And I've got some questions popping up here that I'll answer here in just a second. I'm getting pretty close to the end of my presentation, then I'll open it up for Q&A and cover a few things. I've got 3 more slides yet. All right, so we've covered inflation. We've looked at core CPI. We've looked at gas prices going up and then kind of pulling back. We've looked at lumber prices obviously spiking. We've looked at home prices that have been spiking through the roof, right? We've talked about the impacts of inflation and the big question mark, is it transitory or is it here to stay, right? We looked at the employment situation, talked about that a little bit, and then we've talked about some of the year-to-date returns in the S&P 500 sectors, like how it's performing so far year-to-date. Let's just do a quick look ahead, and then I'll open it up for Q&A. I've got a couple of good ones sitting here in front of me. All right, I talked about a K-shaped recovery, right? This one's looking at it globally, which is an interesting one. We can also get more resolution into this problem. We can take a higher resolution view and maybe look just specifically at the US or even inside of the US, look at different demographic groups, age, ethnicity, location, etc. But here's kind of how the global K-shaped recovery sets up. Essentially what this is doing here is the OECD is saying how long do they estimate it's going to take countries to get back to a pre-COVID level of economic output. So the really light blue is somewhere around 1 to 2 years. China, ironically, the place where the virus originated from, is projected to have the fastest recovery, and some might actually argue they're already fully recovered. The US is looking at maybe a projection of 2 years. And then other states, the darker the blue gets, the longer they're expecting it's going to take for those economies to recover. So again, a K-shaped recovery or a K-shaped distribution is where you have certain segments that are just taking off, and then there's a very disparate outcome for another set of countries, groups of people, etc. An example of this that I might give would be if you were to look at, and this is not a political statement, if you were to look at how, say, Florida and their economy and their demographic growth is relative to Michigan or relative to New York or New Jersey, right? Certainly because of the way they approached the COVID pandemic. And I'm not making a statement as to whether it's right or wrong. This is just what actually happened, right? The tax policies and the COVID policies and kind of the overall economic policies in the sunshine states, right, like Georgia, Florida, Texas, et cetera, versus maybe a Rust Belt state like Michigan, Ohio, Pennsylvania, or even New Jersey, New York, we're seeing vast disparities in terms of demographic growth, migration patterns, housing prices, where the businesses are sitting at. And so even inside of something just as a simple example like that, it's easy to see examples of this kind of K-shaped recovery. Hopefully it comes back to a full recovery for all of the economic kind of areas and units in the United States. Otherwise, we will certainly have troubles, hopefully not in my home state here in Michigan, but I think we've got quite a long way to go yet, actually, in terms of recovery. So, all right, this is a really tough graph to kind of see because the dots are small, but I thought this was important, and so did Alex, our VP of Investment Strategy, who tracks the FOMC. He has the FOMC meeting minutes, like the Fed's trying to hang on to the tail of the tiger. He's trying to hang on to the tail of the Fed. This is an estimation, right? So each dot represents essentially a member of the FOMC committee, which is the Federal Open Market Committee. They set monetary policy and interest rate policy. This is the expectation. It's hard to see by year of where they expect to see the Fed funds rate change. So the far left of this, where you see a bunch of flat line dots, that's 2021. That's essentially all of the FOMC participants, the board of directors of the different Federal Reserve branches, saying we don't want to change interest rates. You see in 2022 a little bit of divergence, with a few more of them expecting some marginal interest rate increases next year, but the majority of them still saying flat. And then you kind of see how that steps in the future. Here's the takeaway. The majority of the Federal Reserve's FOMC participants, their committee, doesn't expect to change interest rates anytime in the next year to 2 years. And if they are, they're going to be slight. But on a longer term, right, they expect to adjust interest rates higher. This might support the narrative that the Federal Reserve views inflation as being transitory, because they're not worried about the economy running too hot or having too much easy money in the system causing inflation. They're kind of keeping those things constant going forward. And we also see that bond yields have fallen. So again, this expectation of interest rates being driven by inflation or the Fed making a massive change to it based off of the FOMC participants' expectations and where they see monetary policy going. I don't anticipate a massive change in direction when they get to the end of their committee meeting either today or tomorrow. All right. As we wrap up here, and I'm going to do some Q&A, a couple of quick dates to put on your calendar. July 16, about halfway through the month, we're going to be holding a fun, informative webinar, and it's going to be an introduction to factor investing. So for those of you that have been clients for a while, you've heard me talk about our acquisition of AimVest Technologies, and one of the things that we're really excited to be bringing to you, our clients, that's been in the works now for the last 6 months, is our quantitative and factor investment strategies. And what we want to walk you, our clients, through is what is factor investing? What is quantitative investing? What are those strategies? What are the differences between that versus maybe what Lifeworks is doing now? What are the similarities, and how do we envision bringing these things together? It's going to be a really fun, fast-paced webinar. It's going to have myself on it. I'll be interviewing Alex Mathay-Cathala, who's our VP of Investment Strategy, Derek Vermeulen, our Chief Investment Officer, and depending on how much time we allocate for it, we might have a few other of our investment team on there as well. So mark your calendars for that. If you can be on the live webinar, that'd be great. Be a great time to get questions answered from the guys who are driving our investment strategy. If you can't attend, we'll get the recording out as well. On July 30th, that's our next market update. There'll probably be a fair amount of updates that we're going to be doing in there because we'll have a few more months of reported data, again, around inflation. We'll be able to start hopefully having a higher resolution answer to the question about, is inflation transitory or is this a trend that's here to stay? And then also where the markets are, geopolitical stuff, employment situation, all the other very fun things that we like to cover. All right, so we're at 12:10. I am actually ahead of schedule. Maybe I should schedule a fishing trip every time I have a market update. It'll keep me on time. Let's tackle a couple of the questions that we have here. And again, if you want to ask a question right now on the live webinar, right below the video is the box where you can submit a question. And just above the video, there's a link that says if you don't see the Q&A box, click here and it'll take you out to our Vimeo page where you can plug in a question right in the chat there. Okay, first question. I think I answered this a little bit in my presentation already, but the first question from one of our clients is, will inflation bring on higher interest rates that dampens the red-hot real estate market? You know, this is a really good question. I was just on a call last night with one of our clients that we were talking about his investment real estate positions and whether he should be looking to exit some of them right now because the market's red hot. And my answer was essentially, well, even if we did, where would we put the money, right? We'd put it in equities, let's say, right? And those valuations are also red hot, as I showed here in my presentation around the CAPE valuation for equities. Would interest rates have an impact on housing valuation? More than likely, yes, in most areas of the country. There are going to be some areas that it might have a very minimal impact on, simply because of the supply and demand effect. So right now there's so few homes for sale that I think even if interest rates were to go up 0.5% or even 1%, the likelihood of it putting a really big damper on home prices in the red hot real estate market is probably not there. Simply because people need homes, people are leaving big cities, there's migration happening from, you know, what I talked about, some of the northern states, the Rust Belt states, to some of the Sun Belt states, right? So I think there are a lot of other factors at play that are driving home valuations, not just interest rate expectations and where that's sitting. From a textbook answer, inflation should be a direct impact on long-term interest rates. Right now, because there's still a big question mark as to whether inflation is transitory or a longer-term trend, we haven't seen the inflation print driving large changes to the long-term interest rates that you would expect in maybe a normal kind of economic cycle or even from a textbook answer to that. So I think the answer there is over the next few months as we see whether this truly is transitory or a trend, then we might start seeing some changes to the interest rate market, but I don't see it impacting home values in a negative way unless other factors start happening as well. And those would be like the economy sliding, the output in the economy sliding negative, maybe even starting a recession or a war, or, you know, something like this that would also have a negative impact on some of the positive things that are going on in different areas of the country. Great question, though. Does recent volatility change your investment strategies? No. The way that we like to think about investment strategies at a very high level is we like to first of all take a picture of it in our minds from a long timeline perspective, right? We know we have to think in the immediate, and we know we have to think tactically because our clients have to take distributions to live on. They are saving for specific events like college or to buy a house or, you know, something like this. But even for our clients that are, you know, in their late 70s and early 80s, some of our older clients, right? We're still looking at their investments on a 10+ year timeline, which means short-term movements in volatility aren't seen by us necessarily as a negative or something that would cause us to change investment strategy. In fact, we've been talking about this for years. If you've been a client, I'm not sure who asked this question, but if you've been a client for a while, you've heard me and Derek and others on the team talk about this expectation that volatility is here to stay. And maybe not even because of market-driven stuff so much as technology's driven it, right? Think about, you know, 5 years ago, what you could or couldn't do on an iPhone or a smartphone. And the sheer magnitude of people that are using Robinhood or other apps on their phone to trade stocks for free, right? This has had a significant impact in the volatility in the markets. The meme stocks, right? AMC, GameStop, et cetera, that happened earlier this year and still are kind of going on, is an example of volatility and, retail day traders in small accounts multiplied times millions and millions and millions of them all of a sudden have the ability to impact the market in an instant. Well, that instant market impact, whether it's for good or bad, is volatility. We oftentimes think of volatility as negative downward movement, but volatility can be spikes to the upside too, right? It's a measure of change off of, say, the median in the bell curve, right? Like shooting to one side or shooting to the other. So for us, when we're thinking about volatility, it might impact how we're approaching some of our hedging strategies for our protected portfolio, but it's not impacting our overall investment strategy in terms of causing us to say we should get out of this equity sector and get into this one. That's not how we're structuring our investment strategies. We're already anticipating volatility, and we expect it's going to increase and just be a function of how we have to invest assets going forward, because Pandora's box has been open. Technology isn't going to get reversed. The meme stock game, Reddit groups, social media driving retail investing into certain stock or sectors, like that's here to stay. Another question we have here, will higher interest rates make bond portfolios a good option again? The current Treasury Secretary Yellen made a comment a couple of weeks back that sent a few ripples in the markets for a few days about, they'd like to see higher interest rates because it's good for long-term savers. This is somewhat relative, right? If we see higher interest rates and those are driven by higher inflation, then the net effect to you might be zero. If inflation rises faster than long-term interest rates, then the net effect would be negative for you, even if interest rates are going up, and that theoretically would show on paper a higher yield on a fixed income portfolio, right? So the answer here would be higher interest rates don't necessarily mean that it would be a better option or that bonds would all of a sudden look more favorable, because it's going to be relative, right? If we have a 7% average rate of, average yield, let's say, on a fixed income portfolio, but our inflation is 6.5% and we have a net real yield of 1, or we can be invested in equities in a thoughtful way and using some of the factors that we are focusing on, value and quality, and maybe even hedging them, and we can earn a real yield that's better than that, well, then the equities are still going to be more attractive. So it's oftentimes easy to look back at history. I've done this before too and said, oh man, I wish I had the 1990s back, right? We were printing, 8, 9, 10% yields on US treasuries, right? Risk-free assets. But then if you look at where inflation's at, and then if you look at the opportunity cost of being in those assets relative to potentially being in equities over time, again, the answer to this question isn't necessarily like, are higher interest rates good for bond portfolios, right? I think the what's good for bond portfolios are sustained interest rates and low inflation where there's actually a real yield on them, right? When we have rising inflation and low interest rates, or even rising inflation and interest rates moving up, the benefit of the increased yield is eaten up by the inflation. So hopefully that answered that question, because that's a little bit of a maybe a technical, not a straight answer of a yes or no, but hopefully answered that question. All right, for those of you guys that have been watching, again, my name is Ron Bullis. I'm the co-founder and CEO of Lifeworks Advisors. It has been my pleasure today to get to take you through some of our team's thoughts and what we're watching, what the news has looked like from our viewpoint from the market. And I hope you found today informative and interesting. As always, don't hesitate to reach out to us, phone call, text, email if you have questions. We'll be publishing a link to this webinar and all the slides. If not by the end of today, certainly by early tomorrow morning, so be watching your inbox for that. I'm going to hang out for a couple more minutes. If there are any more live questions, feel free to fire them my way. If you're jumping off, I hope you have an awesome rest of your week. It's a beautiful day outside here in Michigan. I hope the weather's great where you're at. Be safe and enjoy some time with your family. keep it open here a couple more minutes. Again, the Q&A box is right below the video. If you're having trouble finding that, right above it, there is a link that says click here to get to the questions and comments section. All right, well, I don't see anybody typing in any questions, so I'm going to wrap it up here. Once again, thanks for watching. I hope you found this informative. Have a great rest of your week, and we look forward to having you on one of our live events again in the near future. Take care.